right, welcome everyone. This is the Center of Public Integrity, and I'm Mei Fong, and we are here to have a special session looking at the Tax Cuts and Jobs Act of 2017. We're right now in the midst of tax filing season, and this will be the first time that most of the American public are actively grappling with some of the serious consequences and actively realizing what are some of the effects of the most major tax cut overhaul in about 30 years. And this was considered one of the signature achievements of the Trump administration. So maybe just to set the table a little bit, and I'd just like to announce who we have as our special guest to talk about this. We have here Mark Mazur, who is the director of the Urban Brookings Tax Policy Center, and he was formerly the Assistant Secretary for Tax Policy at the Treasury and a leading economist and a specialist in tax. So we're very lucky to have him. Welcome, Mark.
Thank you.
And also with us as well as Allan Holmes, our lead director and reporter on a whole series of stories that we have done on the tax package. And maybe just to set the table a little bit, gentlemen, can we sort of explain to us what was the thinking that led to this major overhaul? Why did they decide to do this now?
Well, I'll go ahead and start, and from the reporting that we've done is that this was a first and foremost corporate tax rate cut bill for multinationals. That's what what really drove this from the beginning. And if we go back before the election, if you recall, summer of 2016, most people thought that Trump wouldn't win. And so a lot of Congress was gearing up to work with what was going to be a Democratic candidate, Hillary Clinton. And so there's going to be a lot of negotiations and trade-off. The Democrats wanted to cut the corporate tax rate, but when Trump won, we heard from, in our reporting, a lot of the lobbyists said, well, he was campaigning on 15%, cutting it from 35 to 15, where a lot of people thought that was really not able to get to that point, but it was how low can you go? Because a lot of what the Obama administration, which Mark can talk about, they wanted to get to about 28%. But that's really what drove this whole thing, and then everything came after that.
So basically, in other words, in order to get a substantial cuts for corporations, and whomever who got that would get substantial support from the big companies to win the presidential race. Was that basically the thinking behind it?
It was a little bit behind about that, but I think as Alan saying, that the larger part was that there was a broad agreement in Congress that there was a need to cut the corporate tax rate. The U.S. corporate tax rate was 35%. It had been 34 or 35% since 1986. Since 1986, every other country in the world cut their corporate tax rate. And so the U.S., once had been a low-tax country, now is a relatively high-tax country.
So the argument behind cutting the tax rate was that this would make the U.S. more competitive as a business destination. It would make companies want to stay in the U.S., have better economic growth, generate more jobs. Was that basically
that was the basic argument, and the other part of it was just from a financial reporting standpoint, that a lower corporate tax rate meant that the earnings per share for U.S. companies would be higher.
That's true.
And I would just add very quickly that you heard very early on that the Trump administration was positioning the corporate tax cut as something that will increase wages, increase jobs. So that's where a lot of this middle-class tax relief came in, that they really believed that wages would increase. But as we're seeing, and we can get to this later, that's really not is how what we're finding is playing out.
But just to get this kind of a major haul, as I understand it, there was a lot of backstage dealing, right, to just even get this through. And this was something that you've written about to some degree, right, Alan? Do you want to sort of explain?
Well, yeah. What we looked at was one of our first pieces that we looked at was the Republicans were really comparing this to the 1986 tax reform under Ronald Reagan. And so what we looked at was we just compared the processes of both. And whereas what we found was in something quite different. In '86, it was a 2-year process that they held all these hearings, had all these witnesses, really spent time trying to really study every almost avenue of what a tax cut was. Our numbers, and we went back and looked at the congressional record. There were, over 2 years, there were 89 hearings, 2,600 witnesses. They went all over the country. They held hearings in the middle of the country and the West Coast. When you got to 2017, much different dynamic. There was real panic to try to get something through. So we can basically say over 6 months, they held 11 hearings, 45 witnesses, and half of those witnesses came from inside the Beltway.
That seems really
kind of people
rushed.
like Mark.
I did testify.
And you did testify, so you were counted in that. But yeah, it's a much more truncated process, 51 days, written in secret, and where, now granted, the houses were split between Democrats and Republicans in 86, so they had to get together and work things out. Here, the Republicans held both chambers and the White House.
Now, many of your stories have positioned the tax cuts as something that sort of rewards the rich. Is this fair in that sense? What is the justification for this kind of a understanding of the tax?
Well, I think
cuts?
Mark's done a ton of work in this area.
Yeah.
So basically, what the Tax Policy Center found in analyzing the Tax Cuts and Jobs Act is that most people get a tax cut under this bill. Probably 80% of taxpayers get a tax cut. About 5% see a tax increase. The other 15% about the same.
Okay.
But the tax cut is tilted toward higher income people. And part of the reason is because there's a big corporate tax cut. And beneficiaries of corporate tax cuts tend to be those who own capital assets, like corporate stock. And so that's tilted toward higher income people. But also there are lower rates, broader, wider tax brackets, a restructuring of the alternative minimum tax, all of which benefit people toward the top end of the distribution more than people at the lower end of the income distribution. And so very roughly, people in the 95th to 99th percentile of the income distribution, they have the largest percentage increase in their after-tax income. People in the bottom 20% of the income distribution, they might get $60 a year of a tax cut.
$60 doesn't seem like very much,
No, it
does
does
it?
not. And the top end is, tens of thousands of dollars.
Well, this is the part that's interesting, and this is what you had written about too, right? With so much to gain, I would imagine that quite a lot of wealthy donors wanted to see these tax cuts go through. And you did a series of stories on that, right? Can you explain to us what this was all about?
Yeah, what we wanted to look at was right when Obamacare failed, or the failed being repealed in the Senate, famous with John McCain putting his thumb down. That created panic within the Republican Party. They felt like, oh my God, we aren't coming through on our promises. And that's when also some very large donors said we're not giving any more until the tax bill passes. And so what we did is we looked at donation data on campaign donations in the last 2 months of the year, because House bill was introduced on November 2nd, and President Trump signed the bill into law on December 22nd. So we kind of moved into December 31st to give it to the end of the year. And we found that about 87, we looked at donations of $50,000 or more. There's about 144 people who gave $50,000 or more during that time. Of 87 of those were they stepped out of their giving pattern. They had never given in those last 2 months, only going back to 2009. And these are some very not so well-known names and some pretty well-known names, like Schwartzman in New York.
Ronald Lauder, right? From the Estee Lauder.
Yes.
I have a feminine interest in
Right.
that.
Elliot Brody, who was the vice chairman of the Finance Committee for...
So what would you say about the timing of this and the suddenly substantial amounts of money going into it? What are we trying to say here?
Yeah, well, Doug Deason, who actually said this, he said, I just wanted to send a message that we sent them to go to Washington to get this done, and I wasn't going to give until it was done. And he stopped giving in July, and he started giving on November 9th. right when the Senate started taking up its bill. So, and he freely says, yeah, that was the motivation behind it.
And one of the
Okay.
key points of the Senate bill was getting to the fact that it was going to be a net tax cut of $1.5 trillion. That the margin in the Senate was small, and once they got agreement that they could go for $1.5 trillion, that became sort of the mark that they were going up against. And so a tax cut that big gives you a lot of room to cut taxes for a lot of people.
Well, but here's the issue, right? I mean, the way it was couched or sold to the public wasn't just that, oh, we're going to give all this money to rich people. The idea was that would be some benefits that would trickle down to the general population, right? It was supposed to boost the economy. It was supposed to be a boon to jobs, and so has that lived up to its promise?
Well, if you think about how the linkages would work, you'd see that as a proponent of the bill might argue that you'd have a corporate tax cut and you would have a change to a more of a territorial system, so only taxing U.S. income and not worldwide income. What that would do would open the floodgates for investment in the U.S., both from foreign subsidiaries repatriating earnings to the U.S. and from U.S. investors saying, well, we used to have 35% tax rate, now we have 21. Much more attractive place to invest. And so the story would be you'd have this great amount of investment coming in that would lead to more machinery and equipment and other types of assets for workers. Workers would become more productive. They would get paid higher wages to reflect their increased productivity. But for that to work, all those linkages have to work in concert. We're not sure if we've seen that happen yet. I think what we've seen so far is a bunch of money being repatriated from foreign subsidiaries, but a lot of the companies looking around and saying, we don't have such great investment opportunities, so we'll take that money and use it for stock buybacks or dividends. If you just sort of think about it,
jobs.
Not necessarily. I mean, there are some, and you've seen the anecdotes portrayed a lot, where it's like, we're building a new campus in city X, or we're opening up a new shift in city Y, and so you see that. But I think if you look across the board, you don't see a huge increase in investment.
Not that big boost that we were promised, all things considered.
I would just add that we actually traveled to Lordstown, Ohio, where GM
General
is
Motors.
General Motors, where they make the Cruze, which was one of a very, very popular car, and sold very well, but then sales started dropping off. They idled the plant. They didn't close the plant. They've idled it, which means that they could reopen it to build something else. But there are thousands of workers there that are laid off, and GM has got a tremendous tax benefit, and so the workers are wondering, well, what about us?
Wasn't that one of the things that President Trump promised? He made that a signature achievement.
Well, he also
General
tweeted
Motors,
a lot. I mean, if you remember, there was a kind of a tweet storm a little bit, at least one way, from President Trump, saying that going after GM, get it open, because he actually went to Youngstown, which is right next to Lordstown, and said, don't sell your homes, stay here, the money's coming back, the investment's coming back, but GM's making business decisions. They're not making decisions that are necessarily going to be favorable to the Trump administration.
What about for middle-income families? How is this tax cuts? What has it done for us? I would consider myself that.
So I guess we at Tax Policy, we estimate that a middle-income family will get a tax cut on the order of $900 to $1,000 a year, and that will be because the child tax credit was increased from $1,000 to $2,000, so an extra $1,000 per child under age 17, and because rates went down a bit and brackets were widened a bit, and the standard deduction was increased for people who don't itemize their deductions. So all those things in concert reduce taxes on middle-income families. For lower-income families, all those things mean that their tax liability is still zero. Income tax liability is still zero, so it doesn't change. But for middle-income families, there's a reduction.
So if you're in manufacturing, for example, what would be the impact of these things? Are you going to get all these jobs back? Has there been any indications as far? I know it's only been a year, so some of these numbers are rather preliminary, but what are we seeing?
Well, you just had last Friday the jobs report comes out. Strong increase in jobs, 196,000. unemployment rate stays still at about 3.8%. But what's interesting in there, which I don't think was covered a lot by major news organizations, but manufacturing jobs actually dropped 6,000 last month, the first time since July 2017. It really had a good run. But again, what was Mark was saying about these incentives that are supposed to make it much cheaper to invest in the kind of equipment, capital spending that will create jobs, you're not seeing. And then they've revised the February. February was only up 4,000. They revised it down to 1,000. So you can see manufacturing jobs actually shrinking now, and that wasn't supposed to happen. Or at least we were promised that or told that was not going to happen. The tax law would actually have a different impact on manufacturing.
So, okay. What about wages? Have there been any wage increases?
Modest wage increases over the past year, I think. Slightly greater than inflation, which is a good sign. I think that it's not gangbusters, but real wage increases are a plus.
What about any
Well, I'll just add,
Yeah.
just like to add something real quick to that. We did a story on this as well, and the idea is that if you recall back right when the law was signed in December 2017, the next 6 or 9 months you had this string of announcements from major companies saying they're giving one-time bonuses, we're increasing wages. Walmart said the starting wage was going to go up to $11. This was touted it was perfect PR campaign for the Trump administration. This is exactly what they wanted to hear. So we come back beginning of this year and say, well, what happened?
Have the wages
Well,
gone up?
they've stopped. And at the same time, like Walmart announced the $11 increase to $11, they're laying off thousands of employees. AT&T did the same thing. They give a $1,000 one-time bonus.
Yet at the same time, didn't these corporations get nice, big, substantial, savings and
Yes, they did. So, and we talked to again. We went out and talked to some workers over there, saying, I think for example, we were again in Ohio, talking to some workers at Emerson Electric. There, they make air conditioning and refrigeration equipment. They got a one-time $1,000 bonus to their 401k, and we talked to one worker and said, well, I don't want it in my 401k. I need the cash now. And so there's disappointment, and they weren't going to give it again the next year, even though they're getting the tax benefits again.
Yeah.
It kind of petered off. There was a bump in the first year, and there's about 700 and some odd companies that were a couple of groups had tracked. But that's
So
over
some
now.
of these modest increases we're talking about the first year basically after that, we're not going to see this possibly in the year
We'll
after.
see. I don't want to sound too cynical, but some of the companies that paid bonuses paid them at the end of 2017 when as a corporation they had a 35% corporate rate, so they could get a deduction at the 35% rate, not the 21% rate that was going to be coming in next year.
I see. So they may not necessarily have that same kind of inducement, possibly.
It was kind of like a fire sale for making bonus payments.
Now, well, then what about some of the unintended consequences of the Tax Cuts Act? That, this thing was put together in such a hurry, people weren't necessarily thinking about some of the possible effects. And what are some of the things that you're seeing that maybe were not anticipated?
Well, I guess a couple things. One, in the corporate area, multinational area, corporations are trying to figure out how all these new provisions work together. That they were provisions that were put to encourage investment in the U.S., to tax low-income, intangible income abroad, to ensure that companies couldn't profit shift between countries. But while they were all drafted independently, there weren't hearings where they were talked about is a set. And so you have Treasury and IRS trying to write rules to make these seemingly incompatible things work. And one of the results we see that corporations are restating their earnings regularly over the last few years as they try to figure out what the new rules are. And also you see accounting firms and law firms constantly advising clients on what the new strategies might be. So there's a jobs aspect for the Tax Cuts and Jobs Act, but it's like accounting and law jobs, not the manufacturing jobs you were talking about.
No, not manufacturing. Plenty of work for accountants figuring out how it all works, right? What about?
We one small area that we wanted to look at was when the bill was signed into law. There a lot of the charities were very worried about once you double the standard deduction, you take away the itemizing benefits for many, and so we traveled to Covington, Kentucky, spent a few days at the emergency shelter there of northern Kentucky. They house about 75 to 80 homeless individuals every night during the winter, and they depend on very small donations, and mostly the type of the donations they get from is mostly middle income folks. We were told that the more wealthy donors like to give to universities, big healthcare centers, sometimes things that they get their names on, which is all very important. I don't want to denigrate that, but it's what they're seeing is what some of the donors told us there is that they're going to have to they can no longer itemize. It's not in their benefit. They can, but they get a bigger bang by taking, if they're married, the $24,000 deduction rather than the 12. So and the amount of revenue that's coming in from these donors is actually going down, and we just
Which means less services for the poor, for the homeless.
They're going to have to, even just small percentage decreases mean that they have to cut back on their services, which then means they don't serve as many homeless. The report came out just about a month or so ago that this nationwide donations of less than $250 a year were down 4.4%. Last year, $250 to $1,000 was down 4%. Now the bigger donations were up, so overall it was an increase. But and we cited some of the tax center work is that before the tax law, 17% of people making between $49,000 and $86,000 a year, about middle income, they benefited from itemizing. After the tax law, that dropped down to 5.5%. So you can see that you're losing those people.
Yeah.
And you're kind of shifting the distribution of who itemized their deductions toward the higher end of the income distribution.
Right.
So over the longer term, let's say the year after this year, it's conceivable that some of these giving patterns will continue to trend downwards.
And that's the worries that people are now. We talked to some.
habit of
they
giving
gave
less.
in late 2018, December 28th, without realizing that when they sat down to their taxes, oh my gosh, I can't deduct that. So they're saying, what we're going to really see is what we want to see is what's going to happen in November, December 2019 this year, because it could even drop further, but we'll just have to wait and see.
Because you can imagine a bunch of people kept their receipts for their charitable contributions, went all the way through, started to fill out their tax return and go, why did I keep these? I can't use them.
Right.
There's no point, right? Yeah. But so we've talked about what some of the, how it's changed behavior. It might change our philanthropic behavior. It has, but here's the thing. All these slashing of the tax rates means substantially less federal revenue, right? And what does this mean in long term? This is what always the worry, right? Are we going to lead to huge deficits? And then the argument against it was, no, it will generate so many jobs and so much growth that will balance against that, or maybe even surpass that. Is it too early to see any kind of indications which way this is going?
Well, a couple of things. I think one, I think Secretary Mnuchin and others said that these tax cuts would pay for themselves. There is no evidence that is happening here or has ever happened in the past, and so it's a little bit of a surprise to see Treasury Secretary going out and making
that's still being the messaging, right?
And if you just look at the data, the corporate receipts are down about a third, which is what you would expect if the rate goes from 35% to 21%. That's like right in line with what we've seen. Overall, we have an increased budget deficit from fiscal year 2017 to fiscal year 2018 of a couple $100 billion, and we're seeing reduced receipts in the current fiscal year. We're on track to have something like a $900 billion plus deficit this fiscal year. almost $1 trillion.
And what does this translate into for the ordinary person
So for the ordinary person, it may not mean anything to them today,
today?
but essentially what it means is you're pushing the cost of government that we're consuming today onto your kids and grandkids who are going to have to pay this back.
So what's going to mean for our grandkids and all?
They're when
No
they're born,
pensions,
that
no.
they have a big federal debt that comes along with them.
Mm-hmm.
And in the future, future Congresses and presidents are going to have to figure out what to do with that large budget deficit, whether they will raise taxes, possible,
Or slash all sorts
cut
of
spending,
benefits.
that's
Yeah.
possible,
Mm.
do both, probably most likely.
Yeah, it's
Which is a lot of there's a lot of worry that the entitlement programs, the very popular entitlement programs of Medicare, Social Security, Medicaid, could be seeing cuts. Now, those are used to be Social Security was the third rail of American politics. You don't touch it
But-
at the risk. But I think there's a point where there's so much debt, and that the interest you're paying is now going to be larger than the defense budget. You start, people are starting worried about our security. What are we doing just to the financial well-being of the country? And so maybe it becomes much more palatable to make those cuts, or to at least make some adjustments. One thing that they did make, which Mark has pointed out, is that they moved from the CPI measurement, which we used to increase both the brackets, we increased Social Security payments using the inflation, the typical CPI index, to what's called the chained CPI, where you take into account, and again, this is not only just a Republican idea, it's Democrats supported this, is that if prices go up on one product, you substitute a cheaper product into that, so you're not spending that higher value, so it's going up slower.
So here's the thing: when we've published some of these stories, we've actually seen, prominent, mostly Democratic, policymakers saying, "Oh, this is terrible. There needs to be some sort of change." People like Bernie Sanders, have sort of picked up on some of these things and sort of help us amplify the message that this needs to change. But the question is, we are here now. Is there any likelihood that there will be any kind of tinkering or changes to the Tax Cuts Act, or is this kind of pretty much sanded?
Well, I guess a couple things. One, most of the individual income tax provisions expire at the end of 2025. So
What does that mean?
that means that the law in 2025 will be much different. That reflects the Tax Cuts and Jobs Act. The law in 2026 will reflect the prior law.
Okay.
So tax rates will go up for individuals. Child tax credit will go down. The personal exemptions will come back into the system. The standard deduction will be cut down. And so lots of changes will occur in 2025 unless Congress does something. So there is like a natural point to
There is a
do something.
natural sort of inflection point that will be coming up.
But if you're asking what's going to happen in the shorter term, the Democrats in the House may want to change big parts of the Tax Cuts and Jobs Act.
But
The Republicans in the Senate and the President don't. And so almost surely that won't happen. You could see small tinkering where there are things that both parties agree need to be fixed, and then it's just a matter of figuring out what the deal is that they can come to. And in the past, we had a provision called the grain glitch, where co-ops were treated more favorably than perhaps that was intended. And both Republicans and Democrats came together to fix that provision, but the price was an extra $5 billion for low-income housing tax credit that the Democrats extracted from that. So you could see something like that happen.
But so given that, and we are coming up to a major presidential election in 2020, does this have any kind of impact, or will this be one of the bones of contention that will be raised between the two sides?
You're already seeing that. Elizabeth Warren has come out with let's raise taxes on the wealthy. One article that we have coming up, we thought that the earned income tax credit, which is targeted towards working poor, even middle income as well, would be a bigger part of the discussion. I think we only have one candidate talking about that. But yeah, it is. It is going to be a big part, and it already is, on the campaign trail.
And you see some of the Democrats also saying that to pay for some of the things they want to do, they would repeal some of the tax cuts that were in the Tax Cuts and Jobs Act.
Okay. Well, I have actually got some questions that were sent in from some of our readers,
Okay.
and I wanted to sort of pitch them to you to sort of answer to the best of your ability. Okay, so this one's an interesting one. It says, is it illegal for GOP donors to donate to lawmakers if they got the tax law passed?
That's a really good question. If basically asking you, is there a quid pro quo?
Yeah.
I'll give you this money if you give me that.
Yeah.
Yes, 1974
So
campaign
it is
finance
illegal.
law. It is, yes, theoretically.
Why do I hear a but?
Because
That's
it's
coming.
really, really hard to prove.
To demonstrate causality,
To
right?
demonstrate causality. And was there a quid pro quo in very wealthy donors holding back money to give? We thought about trying to go down that road to do reporting on that, but it's just fraught with all kinds of issues.
Yeah,
It's
everyone
hard
gets
to
in.
really prove it in a court.
Because you could easily say, I'm just donating because they're in sync with my preferences.
Exactly.
Yeah, I like his
Yeah.
shape of his face, or the
Yeah.
color of his tie, or any.
Rather than this tax bill just gave me an extra, several $100,000.
Okay, all right. So, okay, so this question, it says, you wrote that no Democrats voted to pass the tax bill, so they're unlikely to repair it. And this kind of refers to it. With election campaigning under the way, do you still think that's the case?
So I could see some repairs to the bill. There's a provision in the way that restaurants and retail stores can depreciate any improvements they make.
Uh-huh.
The Congress, I think, intended that to be immediately expensed, but the way the law was written in haste gets depreciated over 39 years. Everybody has restaurants and retail stores in their district. This is something that lots of members will be pressed to do something about. But this
And-
gets back to what the cost is of doing it, because no Democrats voted for this. And frankly, no Republicans agreed to make necessary technical corrections to the Affordable Care Act. There's been a bad history here.
So
to
this
define
just
things.
be left in the sort of a sidelines just because of partisanship.
You would think not, but we're in a very partisan time now.
That is
And
true.
I would just back up what Mark says, that in our reporting, we've been told by a number of very smart people who have a lot of connections on the Hill that the Democrats don't really want to help the Republicans at all, again, because of the not getting any help of trying to fix some of the problems
so
of the
they're
ACA.
probably not going to try and
Obamacare.
fix anything. They just want it to sort of
Right.
fall into some sort of a horrible
They
hole.
just want to sit back and say, well, you hoisted yourself on your own petard, and not really help, unless I think they can get these really big extractions of what they want.
Okay, so this is the one question. Are there any major benefits to this tax laws? Didn't change.
To the economy as a whole?
Yeah.
I'd say to the economy as a whole, yeah. I think that one of the, if you were to look at things that are true reforms in this tax bill, the way that multinational corporations are taxed is a true reform. And that what Congress tried to do and did was shift from a older 1950s era way of taxing multinational corporations to a one that's much more in line with other of our trading partners. Now, they may have gone too far and cut rates too much and provided too much incentive, but they really did reform that in a way that probably was necessary.
Necessary.
In addition, on the individual side, they raised the individual standard deduction a lot. That will simplify people's lives. This goes back to the point that was being made earlier about charitable contributions. It'll be simpler if people don't have to save those receipts for charitable contributions. It may have a knock-on effect for those contributions themselves, but it'll make life simpler for taxpayers because they'll just claim the standard deduction and kind of move on. So there are some benefits
There
to
is
the
some
bill.
benefits.
And I would just underscore, I think, is that a lot of people think that the middle class didn't get a tax cut. Mark pointed out earlier on that they did. I mean, it is a net benefit to the middle class. Now, you can argue about how much that is and whether that's helpful.
And you could argue whether it's temporary or permanent.
And temporary, yeah, exactly, because I was talking about 2026 things totally go back to the way things were, but there is a
Okay.
net benefit.
So we're almost out of time, so I'm just going to want to finish this by asking you both to sort of sum it up, in terms of, all right, so we've had this major tax overhaul, there've been some benefits, and obviously some parties have benefited more than others. Long-term wise, what are we looking at potentially that could be some problems? So would you both indulge us in sort of putting it to the audience exactly so that they can understand a very complex issue in, 5 sentences or less. No pressure.
Sure. So there's a couple things. Like one, this tax bill was passed at a time when the economy was close to full employment and growing reasonably rapidly. This is typically the time when you raise taxes, not cut taxes. If you were serious about balancing the federal budget, you would look back to the last time that we balanced the budget, the late 1990s, early 2000s, and you'd say, well, at that time, receipts were about 19 or 20% of gross domestic product, 19 or 20% of GDP. And given the extra demands we'd have from an aging population, you would aim for that level of revenues, or maybe even more, to balance the budget. Instead, what we saw was we're cutting revenues from 17.5% to 16.5% of GDP. So it's going the exact wrong direction. And really what that means is that you're pushing the costs of today's government onto future generations. And that's something that people have to deal with in the future. Probably not a fair thing to do.
Mark just took a little bit of macro. I'll try a little micro. I think what, at least from our reporting, is that the promises that were made about increased wages and all these jobs coming back so far isn't occurring. And I think that as we move forward, it's probably, if you were going to bet, is that's not going to. Except there's a couple of economists say, well, a lot of these investments are done over 6 months to a year, and they still might come in later. But one of the incentives, because if you can write off 100% of the cost of equipment, a lot of people have said, well, that's just going to increase the automation of the factory floor, and you're going to get rid of it. Now it's much cheaper to invest in automation. But
that's kind of ironic, right?
Yeah.
It's going to hasten.
Right. So I just think people might just feel a little betrayed a little bit. They were sold some promises that did not come out. They're based on old supply-side economics that I think for the most part haven't proven totally what people think that they should be. So I think on the will that have some political implications? I don't know, because I don't cover politics. But I think on that level, it's going to, people are going to think that, hey, I didn't get that huge increase in wages, and the number of jobs in some of these Rust Belt towns just aren't coming back.
Okay. Well, I think that was a great summary. Thank you so much. Thank you all for tuning in for this, for those of you who tune in Facebook on the live stream. But we'll also be posting this up so that this can be watched after the fact. Thank you so much.